Investors are watching major economic events this week. The Federal Reserve gearing up for its final meeting before the election today and tomorrow. That, of course, ahead of the jobs report, which comes out on Friday. Economists are expecting an addition of 175,000 jobs to have been created in the month of October. They're also looking for the unemployment rate to move lower to 4.9%, which could affect the Fed's actions. Joining us right now is Schwab Senior Vice President and Chief Investment Strategist, Ann Sonders. Ann, good to see you.
Hi, Maria. Thanks.
Thank you so much for joining us.
Thanks.
Any expectations out of the Fed when we hear from them tomorrow, and what do you look for out of the jobs report?
You might get a bit of a hint that December is still on the table, but I don't think that's anything terribly unique relative to what they've been saying in the last couple of months. I think, the jobs report, I think, is only a needle mover if it's significantly below expectations and there's, say, election-related turmoil. Other than that, I think December is happening.
175,000 jobs. John, would that also basically confirm to you, yes, the Fed is going to raise in December?
The Fed just wants to see the economic data go as it's been going, and then they'll move in December. So as Ann says, if there's a big negative surprise, then maybe people say they're not going to move in December, and then we'll get a market reaction.
But I think it would have to be in conjunction with other problems, either a significant spike in the dollar that caused tighter financial conditions or some election-related volatility that goes beyond what's expected in conjunction with a weaker jobs report. I think
we've seen long-term interest rates go up by almost a half percentage point in the last few months. What do you make of that, and how serious a problem could that be for the economy?
Well, we are seeing most of the traditional inflation measures pick up. PCE is still below the Fed's target, but CPI is above it. And when you look at the wage data, average hourly earnings, which have picked up, are still somewhat subdued. But the Atlanta Fed has a unique wage tracker that I think is good in that it's a same-store sales-like measure of wages, because average hourly earnings can be skewed by mix shift, where the Atlanta Fed's version just looks at people working for a full 12-month period. And that shows a full percentage point higher, 3.6% wage growth. So you're starting to see some of this wage impact on inflation. That is the factor that the Fed keeps an eye on.
What do you do in terms of markets right here?
We have been telling investors to sort of stay put. Our official recommendation on U.S. equities is neutral, which means stay at your long-term normal strategic allocation. If there's volatility, use it to tactically rebalance. But in advance of the election, don't make any major moves.
Is there room for a post-election bounce?
I think it depends on expectations leading into the election, which, as we know, normally you'd have sort of set expectations, but this is a very unique election, and things can change even over the next week.
What gets you the bounce? What kind of outcomes get a bounce in this market?
With no political bias in this comment, we were talking before we came on, it's our view that the least unsettling outcome for the market would be a bit of a status quo and with checks and balances. So, Clinton win both the House and the Senate staying Republican. I think that is a scenario that has been built into expectations because it represents a bit of the status quo. If you then see some cooperation and an attempt at getting the things that are most important to get done, in particular corporate tax reform, I think that would possibly give you a bounce. At either extreme, a Democrat sweep or maybe a surprise Trump victory, i.e. if we head into the actual election with polls saying otherwise, a Brexit-type situation, then I think you get some volatility, and then it's hard to say at what point you may get a subsequent bounce.
I was just going to point out the Wall Street Journal writes that volatility jumped the VIX jumped more than 5% yesterday. It usually peaks 6 days before the election, but between now and next Tuesday, given what's happened so far in this election cycle, could it be really, really frightening?
It could, and there's no usually in this election. I don't think that really can be a qualifier on anything we discuss. So I think given the latest news and the fact that we are still going to see probably the polls and the psyche of voters move dramatically, I think that's a perfect explanation for why volatility picked up.
The Hillary Clinton campaign said yesterday that they support moves to strengthen regulations on banks, that they're supporting the Fed's move. Clearly, it's a bit of a juxtaposition because she's taken so much money from Wall Street banks. What do you think the Street is expecting in terms of a Hillary Clinton presidency as it relates to financial regulation?
Well, maybe what the expectation is and what the desire is are still two different things. So I think the question is, if Clinton goes in with more of a, Elizabeth Warren bias versus a more moderate bias, then it's even more important that the House stays in Republican control. So there's some checks and balances on that. I think the regulatory environment for the financial institutions is already extraordinarily high. So ideally, they don't get worse from here.
Can we talk about the Fed for a second? Mm-hmm. So the market is pricing in a Fed rate increase.
Yeah, what a 65% futures market expectation.
Yeah. Actually, the last time I looked, it was closer to 70%. Is the market ready for that? Do we get another sell-off if the Fed goes ahead and raises rates in December?
Boy, you mean like January and February last year?
Yeah.
I don't think so. I think that this hike is expected. It was also the case that when the Fed hiked last year in December, what was built into expectations based on the dots plot was 4 more hikes over the course of the next year. And I think that is what is different now, a move this year in December versus last year in December. I think the view, rightly so, is that the Fed is going to be unbelievably slow. And if you look back in history, and you look at slow cycles versus fast cycles. We haven't had a slow cycle since the late 1970s, when the Fed was not moving at every or most consecutive meetings. Slow cycles have seen market performance significantly better than fast cycles for obvious reasons. If the Fed's moving slowly, they're not chasing an overheating economy or chasing an inflation problem. So I think if the Fed keeps those expectations that they're going to continue to move very methodically, I think the markets is okay with that.
Some people said yesterday, I forget who came on the show yesterday, they were saying one and done. We'll see rates move in December, but we won't see much after that.
You said that last year, too.
They said, could it be I don't know that we should start to assume that just every December they're going to raise rates and no other time. I think this is the year, next year is the year, where the inflation data is going to be extremely important, because the worry is the opposite of what we've been dealing with, that inflation picks up and then the Fed is perceived to be behind the curve. I think that maybe not a high risk, because I don't think we actually have an inflation problem brewing. But if we have an inflation scare and the Fed is perceived to be behind the curve, that's not a great environment for stocks.
If it picks up, it looks like it's going to pick up very, very slowly and gradually. It's been 4 years below the target. It's hard to see it going really gradually and then all of a sudden popping up.
Well, again, you could have an inflation scare because you've got the base effects now kicking in terms of commodity prices, which could take you into a situation where the headline level of inflation is higher than the core level of inflation. And that could generate a little bit of an inflation scare, especially if we continue to see higher wages.
So in an environment where there's no growth, and that's going to hold the Fed back, as we've been talking about, where is the growth?
Well, I think as an investor, you want to still focus on earnings growth. Now, interestingly, we do not make calls on growth versus value in a traditional sense. I think this is a growth-oriented market, but you can find growth many times in areas, in industries, sectors, and stocks that tend to be housed in the value indices. And that, I think, trips some investors up. So we actually, we sort of have a growth play and a value play in our sector recommendations. Financials actually a bit on the value side, and then technology on the growth side.
All right, we'll leave it there. Liz Ann, good to see you.
Thanks, everybody.
Thanks so much. Liz Ann Sonders, Charles Schwab. Still to